taking consideration of systemic risk gives you a lens to find opportunities. Some of the opportunities, as in all investing, work out, some don't. But there is nothing inherently negative about using a systemic lens to think about these issues, and it does provide a different window to analyze your investments. Jon Lukomnik. I am a longtime institutional investor, and I also am an adjunct professor and a Brandon Meyer Fellow at Columbia, where I teach sustainable investing. For diversified investors, which is basically everyone, and certainly institutional investors like endowments and foundations and pension funds and sovereign wealth funds, the level of the market affects 75 to 94% of your long-term return, and your security selection and portfolio selection only affects 6 to 25%. And I'm not minimizing 6 to 25%. It's a lot of money. But the overall health of the market matters much more. So what determines the health of the market? Well, a couple of things. The health of the economy, how well the capital markets translate the opportunities and risks in the economy to your portfolio. And then the health of the economy itself is reliant on the health of the environmental, financial, and social systems. And inequality is a threat to the social system. There are three major impacts of inequality on the economy. First, increased inequality results in decreased consumption because the wealthiest fifth of the population consumes at about 1/60th the rate of the bottom fifth of the population. And so you have decreased growth in GDP. If you're removing workers from the economy long term, you're decreasing the productive capacity of the economy long term. You're also not educating them. So in a knowledge-based economy, they are less productive. So you have both short-term decreased consumption and long-term decreased human capital investment that work across the entire economy. That doesn't just affect one company or another. Second, increased inequality creates more and deeper and longer recessions. Interestingly, that since inequality has grown in the United States, the debt to GDP increase during a recession has about quadrupled from what it was before. In other words, what we spent to get out of a recession was 1/4 pre the Reagan tax cuts as what it's been since. Third, it leads to increased country risk, decreased reliance and trust in institutions, decreased rule of law, and country risk raises the fixed income costs of sovereign debt and a bunch of other things. I teach something called system level investing. And what that says is, let's figure out what the systemic risks to a diversified portfolio are. What are the things that contribute to the health of the environmental, social, and financial system? And it's a pretty severe test. We look at consensus, relevance, effectiveness, and magnitude, a 4-part test. Investors can't do everything. They're not governments, but they can pick and choose a few systemic risks that are relevant to them particularly. If they have membership like a pension fund or a time frame in a jurisdiction like a sovereign wealth fund, that matters. And so what system level investors do is they sit, and instead of doing traditional activism, I guess you'd call it, of the type that a Bill Ackman or a Carl Icahn would do, they start with, what's the systemic risk I'm trying to deal with? How do I deal with it through a combination of stewardship and engagement with public companies, capital flow, policy lobbying, increased thought leadership, self-organization of how they do it, or how the investment industry writ large does it. The 4 criteria that we use to determine if something is truly a systemic risk is consensus. For something to be a systemic risk, there's generally a broad base of knowledge about it. What's the impact of climate change has been studied pretty severely. Similarly, inequality, the statistics I use on inequality come from the World Bank and the IMF and the Economic Policy Institute and Moody's Analytics and a whole host of economists. So that's consensus. Relevance. Is it a systemic risk that's going to affect my portfolio? To do that, you have to be able to trace the transmission mechanisms for the systemic risk to the impact on the system to the economy. Effectiveness. Is there anything I can do about it? And magnitude. Is it big enough for me to care? Anytime you're talking about decreases in GDP that are measurable, increased recessions, decreased periods of growth, that hits the economy. Anytime you're talking about increased country risk, that is a very traditional risk, but we're used to thinking about it for emerging markets. People are now saying it's also a risk in developing markets, in developed markets, because of the growth of inequality. A lot of them are asset class specific. So for instance, in private equity and in infrastructure, a number of investors are requiring fair labor practices, whether they're ILO standards or others. Many obviously have executive compensation plans that deal with those issues. In the UK, there's a whole fair living wage campaign. There are also things that we don't think about on inequality that really are very important. For instance, fair taxation. 50% of the United States' international corporations' revenues are booked in low tax jurisdiction. That starves the educational systems, the health systems, et cetera. And so there are some investors who are starting to look at fair taxation issues. Many investors invest deliberately in things that alleviate some of the symptoms of inequality, like affordable housing. When I ran the City of New York's pension fund investments, we built thousands of units and financed tens of thousands more. What we found, interestingly, was that although we were providing market rate mortgages, they were in areas that banks traditionally didn't lend to. Some were new construction, some were rehabs. And what happened is, because they were in areas that banks didn't traditionally lend to, they didn't get refinanced as quickly. And anyone who knows anything about mortgages will tell you that convexity is almost like an implicit put against the lender. And so we wound up with mortgages that we had managed to dampen the convexity of, and it wound up being our best performing fixed income asset class in a bizarre way. Even though we were providing affordable housing and people think that's concessionary, it actually turned out to be a really great investment. In fact, I remember how we stopped the program. Is the person in charge of the program came to me one day and said, "We have a problem. The banks have figured this out, and they're now competing with us to lend, and the rates are going down." And I said, "That's not a problem. That's a victory. Let's find the next dislocation and try and take advantage of that while solving the problems." So in fact, it turned out to both provide mortgages for tens of thousands of families and make a lot of money for the city's pension funds. Taking consideration of systemic risk gives you a lens to find opportunities. Some of the opportunities, as in all investing, work out, some don't. But there is nothing inherently negative about using a systemic lens to think about these issues, and it does provide a different window to analyze your investments. Modern portfolio theory, which is why you diversify, assumes that the market affects your portfolio, but you don't affect the market. The reality is you do. We've all heard about risk on, risk off markets. That's people affecting the portfolio. Index effects, people affecting the market. Super portfolios where the Magnificent Seven fly up away from other things in a correlation that shouldn't really exist. It's people's investments affecting the market. Those are unintentional impacts. The question is, can you intentionally impact the market? And what's missing is this idea that you can, but you have to go into the real world to do it. MPT relies on three theories: rationality, homo economicus, random walk, and efficient market hypothesis. They're very explanative. They make a lot of intuitive sense, and they're wrong. What all three of those theories do is they assume away the real world. They assume away the psychology of investors on behavioral finance. They assume away that psychology and the way capital flows work on random walk. They assume away the need to understand how information actually is absorbed or not on efficient market hypothesis. And it makes the math of modern portfolio theory really easy. But it only helps you on that 6 to 25% that's security selection. So I'm a big believer in diversification. And I am not saying that system level investing replaces modern portfolio theory. In fact, the truth is what we want to do in investment speak is shift the entire opportunity set of the capital markets up and to the left. What that means for an investor is up is higher return, left is less volatility. If by going into the real world and decreasing the risk to the environmental, social, and financial systems, you can do that, you can then apply MPT on top of it so that you can extract the best risk-return portfolio from a better opportunity set. So what are the courses missing? They're missing the fact they assume that investing takes place on a Bloomberg terminal, that it doesn't happen in the real world, that someone exercising their governance rights with a company is less important than a trader. I'm not sure that's true, because risk and value are created in the real world. They're priced in the capital markets. And if you want to decrease risk and increase value, you have to go into the real world to do it. And increasingly, investors are doing just that.